On March 19, the Bank of Japan, BOJ, raised interest rates for the first time since 2007, pushing interest rates above zero to close a chapter in its aggressive efforts to stimulate the economy from has long struggled for growth. BOJ also became the last bank in the world to end the negative interest rate regime after showing signs that the decades-long deflation had ended. The Bank of Japan ends the era of negative interest rates. In 2016, the Bank of Japan took the unorthodox step of bringing borrowing costs below zero, an effort to jumpstart borrowing and lending and boost Japan's sluggish economy. Country. Negative interest rates, which central banks in some European economies have also adopted, mean depositors have to pay to keep their money in banks, an incentive for them to spend money instead. But Japan's economy has recently begun to show signs of stronger growth. Inflation, after years of low levels, has accelerated, underpinned by higher-than-normal wage growth. Both are clues that the economy may be on a path to more sustainable growth, allowing the central bank to tighten interest rate policy years after other major central banks raised rates quickly to deal with soaring inflation. Even after the move on March 19, interest rates in Japan are still far different from other major developed economies in the world. The Bank of Japan's target policy rate has been raised to a range of 0 to 0.1%, from negative 0.1% previously. The BOJ, in a March 19 statement, said it had concluded the economy is in a healthy cycle between wages and prices, meaning wages are rising enough to offset rising prices, but not so much as to cut into business profits. The main inflation index in Japan was 2.2% in January, the most recent figures available. The central bank also abolished the policy of buying Japanese government bonds to limit market interest rates from rising, encouraging businesses and households to borrow cheaply. The bank has gradually eased this policy over the past year, leading to higher bond yields as the country's growth outlook improved. The BOJ said negative interest rates and other steps it took to stimulate the economy have fulfilled their role. In many countries, rising inflation has been difficult for consumers and policymakers, but in Japan, which has often struggled with growth-suppressing deflation, rising recent prices have been welcomed by most economists. The Japanese stock market, supported by economic optimism and corporate reforms beneficial to shareholders, has attracted huge amounts of money from investors around the world. Nearly this helped the Nikkei 225 index break the record high that has existed since 1989. The Nikkei index increased slightly on March 19 after the BOJ announcement. Inflation target within reach. The removal of negative interest rates, which would help shore up the country's weak currency, is seen by investors as another important step in Japan's turnaround. This is another important milestone in normalcy, said Arnout van Rijn, a portfolio manager at Robeco who founded and runs the Dutch fund managers Asia office. Monetary policy in Japan. As a longtime follower of Japan, this, in my opinion, is very meaningful. Investors' increased bets on a BOJ interest rate hike got a boost this month after the Japan Confederation of Trade Unions, the country's largest trade union association, said its 7 million members would get a pay rise, averaging more than 5% this year, the largest annual wage increase negotiated since 1991. That increased average wages by about 3.6% by 2023. Before the results of wage negotiations were announced, investors expected the Bank of Japan to wait longer to raise interest rates. Rising wage growth is an important sign to policymakers that the economy is strong enough to generate inflation and can withstand higher interest rates. Like other major central banks, the Bank of Japan has an annual inflation target of 2%. The rate has been at or above that level for nearly 2 years. Mr. Van Rijn said the wage increase signals that companies and workers expect prices to continue rising. People no longer think falling prices will affect wage demand. The Bank of Japan, in its statement, concluded that it is highly likely that wages will continue to grow steadily this year, following steady wage increases last year. The Bank of Japan's interest rate move is also important because it is the last major central bank to escape negative interest rate policy. Negative central bank policy rates have boosted global bond markets, with more than $18 trillion in bonds trading at peak negative rates in 2020. As inflation and economic growth turn back, central banks raised their policy rates much more aggressively than central bank policy rates. In Japan, almost no bonds currently have negative yields. Rising interest rates in Japan make investing in the country relatively more attractive for investors, but the U.S. Federal Reserve's target interest rate is still about 5 percentage points higher than that of the central bank. European Central is 4 points higher. While foreign investors have begun pouring money into Japan, for Japanese investors, overseas returns remain attractive, even as the Fed and ECB are expected to begin interest rate cuts, hindering quick cash transfers to Japan. The Bank of Japan also proposed making gradual changes in policy. Raising interest rates too quickly could snuff out growth before it gets going.